Welcome to The Explainer. Let's get right into it today, because we're talking about a concept that literally flips traditional financial wisdom right on its head. I mean, most people naturally assume that to be a successful trader, you got to be some sort of market genius who wins 70, 80, or even 90% of the time. But what if I told you that is an absolute myth?
Okay, let's dive into this. Do you actually need a 70% win rate? Well, the short answer is absolutely not. We're going to bust this myth wide open today, because some of the world's most legendary market wizards, traders making absolute millions of dollars, they only win a fraction of the time.
I know a 20% win rate and an 80% loss rate sounds like a fast track to going totally broke, right? But in reality, a 20% win rate can generate massive portfolio-changing profits if you rely on what we call asymmetric risk-to-reward ratios. Basically, if you're risking one single dollar to make $20 on a trade, you can afford to lose 8 out of 10 times and still walk away incredibly profitable. It's wild, but it's just math.
So, here's our roadmap for today's explainer. First, why swing trading? Second, the foundation, the 1% rule. Then we'll cover Strategy 1, trend continuation. Strategy 2, the reversal. Strategy 3, volume profile. And finally, your path to profit.
All right, part 1. Why swing trading?
If you've ever tried day trading, you know the burnout is incredibly real. It literally puts your nervous system in a constant state of fight or flight. I absolutely love this quote from our sources. There's this highly successful Wall Street trader who recently made a staggering $10 million on a single swing trade in the Nikkei market. And he said, "I already traded my health for wealth." He realized that being glued to his screens 12 hours a day as a day trader was just destroying him. But by stepping away from all that intense intraday noise and moving to swing trading, he found that making major calculated moves on a daily or weekly chart gave him his life and, his health back.
Moving on to part 2, the foundation, risk management, and the 1% rule.
So, the crucial point is this. Before we look at any sexy chart setups, we absolutely have to talk about survival. The golden rule is you must never, ever risk more than 1% of your total account on any single trade, period. This is your shield. Even if you hit a terrible losing streak, and let's be real, that happens to everyone, risking only 1% ensures you actually stay in the game long enough to catch that massive 1-20 winning trade.
Let's actually walk clearly through the math here so you can see exactly how to apply it. Let's say you have a $50,000 account. Your 1% portfolio risk is a maximum of $500, right? Now, say you find a stock setup and your trade risk, meaning the exact distance between your entry price and your stop loss, is $2 per share. You simply divide your $500 portfolio risk by that $2 trade risk. The math tells you exactly what to do. You buy exactly 250 shares. It completely removes all the emotion and keeps you perfectly safe.
Okay, part 3, Strategy 1, trend continuation. This approach is heavily inspired by market legends like Mark Minervini and Nicholas Darvas. We call this the expansion box setup. And here's the exact rhythm of the trade. First, you identify a growth stock that already has strong momentum, like it needs to have pushed up at least 10% recently. Second, you just wait. Literally sit on your hands. You wait for the stock to enter a sideways consolidation phase, forming a box or a coiling flag pattern. This is basically the market building pressure. And third, the absolute second the price breaks above that box's resistance with strong volume, you pull the trigger and enter the trade.
Now, once you're in, notice the vital role of the 20 simple moving average. You don't take early profits here. Instead, the 20 SMA becomes your ultimate line in the sand. As long as the price stays above it, you hold. This is exactly how you write a trend for those massive 1-15 or 1-20 reward ratios. You only exit when the market definitively closes below that 20 SMA. That brings us to part 4, Strategy 2, the reversal.
While the last strategy was all about following the trend, this one, which is best traded on a weekly time frame by the way, capitalizes on sudden aggressive shifts in market psychology. And this brilliantly illustrates the core of the setup, the outside bar. Imagine a stock has been trending down for weeks, right? Everyone is bearish. But then, a new candle forms that completely engulfs the high and the low of the previous candle and closes aggressively in the opposite direction. It signifies absolute emotional exhaustion from the sellers and a massive psychological reversal, which creates a perfect asymmetric opportunity for you to buy.
So here are your strict setup rules for the outside bar. First, You gotta have a strong prior trend of at least 6 to 10%. Second, you spot that highly decisive engulfing reversal candle on the weekly chart. Third, you enter your trade right on the close of that candle. But listen, here's the most important part. Your stop loss must be placed exactly at the high or low extreme of that specific reversal candle. No exceptions. That's how you fiercely protect your capital if the reversal ends up failing.
All right, part 5, strategy 3, volume profile and ranges.
This strategy is the perfect tool for those times when the overall market is just stuck going sideways. To really get this, we need to understand the difference between two key zones. A high volume node, or HVN, is an area where a ton of trading activity took place. The market is digesting value there, so the price gets stuck and just consolidates. A low volume node, or LVN, had very little trading activity. Because nobody is defending those levels, price moves through them incredibly fast. As a swing trader, your goal is to capture that fast, aggressive price transition as it leaves one high volume node and just shoots right through a low volume node.
Right smack in the middle of all this is the POC, or point of control. This is the specific price level with the absolute highest traded volume activity. Think of it like a massive magnet. It represents the ultimate break-even point for long-term players, meaning it acts as massive support or resistance. Knowing exactly where the POC is can perfectly guide where you place your entries and set your target exits. So how do we actually trade this? We use the stuck-in-the-box strategy. Step 1. Identify a clear sideways range with a firm support floor and a resistance ceiling. Step 2. Wait patiently for a fakeout. Seriously, you want to see the price drop below support, which traps all those impatient retail traders into selling. And Step 3. Enter the market on the strong bullish rejection that follows. You're essentially buying the trap and swinging the price right back up through the low volume nodes toward the resistance ceiling. It's a beautiful thing. Let's move to and see how this builds into part 6. Conclusion. Your path to profit.
We've covered the mindset, the math, and the mechanics. Now it's all about execution. Here is your homework, and I'm speaking directly to you right now. First off, do not get overwhelmed. Just pick one of these 3 strategies to focus on, whether it's the trend continuation, the outside bar reversal, or the stuck in the box. Master it. Second, always check your sector trends. You want to make sure you have the broader market wind at your back. And third, paper trade. Seriously. Open a demo account and practice your execution and that strict 1% risk management before you ever risk a single dollar of your real, hard-earned capital.
Ultimately, swing trading is a massive test of patience. You aren't reacting to every tiny, stressful movement on a 2-minute chart anymore. You're a sniper waiting for the perfect setup. So, I'll leave you with this question. Do you have the discipline to wait for the perfect pitch, or will you just keep exhausting yourself swinging at every intraday wiggle? The choice between burnout and calculated, scalable profits is entirely yours. Thanks for joining us, and we'll see you next time on The Explainer.